The world moves around money. And the importance and success of a person solely depend on how much wealth he possesses. Everyone aspires to become wealthy and successful as a result. And which quick rich strategy is the best? Stock market? However, 90% of people find their plans don't work out as planned and lose their hard-earned money in a single day. Similar to the housing bubble in 2008 or the dot-com bubble in 2000, there have been numerous stock market crashes. Through the centuries, crashes have made their presence felt by people. The Tulip Frenzy in 1637 is one of the oldest such crashes that many people must be aware of. Let's go 74 years further in 1711 and learn about what may be the first stock market crash that shook up Britain's economy. The South Sea Bubble has been referred to as the first stock market crash and the first Ponzi scheme in history, a passion for speculation, and a terrible illustration of what may happen when people succumb to greed. That it was a catastrophic financial collapse and that some of the best intellectuals of the era, including Isaac Newton himself, perished is beyond dispute. According to various estimates, Newton may have lost as much as £40 million in today's currency in the plan. In the 1500s, Europe was discovering land beyond their continent. Many embarked on perilous expeditions to explore the uncharted oceans hoping to find El Dorado. The various European nations were competing to conquer nations on other continents. Many shipping companies opened up in different parts of Europe. They dealt in commodities like food, textiles, raw materials, and finished goods. But the most lucrative and profitable trade was of enslaved people. Many businesses engaged in the trade of purchasing slaves from nations in Africa and selling them in so-called new lands like South America and North America. There was a lot of work to be done with the arrival of the European settlers in these new regions, including building structures, paving roads, clearing woods, etc. There was a massive need for laborers. During the early 1700s, the British Empire was in dire financial straits. Britain was involved in two simultaneous wars. Both these wars lasted decades. To service their debts and finance the wars, they decided to enter the lucrative slave trade, and in 1711 they established the South Sea Company, a public-private collaboration. In 1713, the company became a monopoly in the slave trade in Britain as no other company was allowed to sell slaves. The people flocked to buy the South Sea Company stocks because the average British person recognized how profitable it could be. One of the biggest clients for these enslaved people was the Spanish. They owned substantial land holdings in South America. Remember, the War of Succession in Spain was underway in that period. It was anticipated that Spanish territories in America would experience a significant increase in commercial activity after the war, which would translate to more slaves being sold. The number of stock purchases increased, increasing the stock price. The price had already risen too high than the company's earnings could justify. But the exact opposite occurred once the conflict ended. The peace treaty signed was a big blow for the South Sea Company as the company was allowed to operate only a limited number of ships. Slave import was taxed heavily. On top of everything else, the Spanish demanded a share of the revenue from the slave trade in the Spanish colonies. This was unlikely to generate anywhere close to the profit the South Sea Company needed to sustain. King George himself decided to take over the business in 1718. With the king at the company's helm, the investors believed the business would never collapse. But there was no rise in earnings. However, public confidence rose to new heights with the monarch in charge of the business, and the South Sea Company's stock price followed suit. The business was taking loans at high interest rates to finance its not-so-profitable operations. In 1718 war broke out with Spain once again. The company's assets in South America were seized. Any prospect of profit from trade, for which the company had purchased ships and had been planning its next ventures, disappeared. Britain, which was reeling under debt, introduced a scheme to convert the annual payouts into South Sea Company stock. The debt holders agreed as the shares backed by national debt were considered a safe investment and a convenient way to hold and move money, far easier and safer than metal coins. For debt holders to earn their principal back need to sell stock at high prices, but how will the stock price will rise with low or no profitability? The company floated rumors about the value of its potential trade in the New World. The rumors led to buying frenzy, which raised the stock price from £128 in January 1720 to £550 by the end of May. Shares in the company were sold to politicians at the current market price. However, rather than paying for the shares, these recipients held on to what shares they had been offered, with the option of selling them back to the company when and as they chose, receiving as profit the increase in market price. This method, while winning over the heads of government, also had the advantage of binding their interests to the interests of the company. In order to secure their own profits, they had to help drive up the stock. Meanwhile, by publicizing the names of its elite stockholders, the company managed to clothe itself in an aura of legitimacy, which attracted and kept other buyers. The stock price reached a dizzying £1,000 by August 1720. Its success caused a countrywide frenzy. Herd behavior. 6 As all types of people, from peasants to lords, developed a feverish interest in investing, in South Seas primarily, but in stocks generally. Although it was a self-reinforcing loop, it lacked any significant fundamentals. And then the selling started. The debt holders, politicians and royals dumped their shares. The prices collapsed. The bubble burst. Stock lost 80% of its value, falling to a pitiful £124 by December. People lost thousands of dollars, investors were bankrupted, suicides significantly increased, and there was a general feeling of rage and unhappiness among Londoners, who demanded an explanation. Company failures now extended to banks and goldsmiths, as they could not collect loans made on the stock, and thousands of individuals were ruined, including many members of the British elite. Even Isaac Newton, a genius, lost the equivalent of £40 million in today's money. The crash caused widespread public outrage. Politicians urged an investigation. Directors of the South Sea Company were charged with treason and fraud. Plays, poems, and satirical prints lambasted the market. The company's directors were compelled to testify before the legislature. In the Tower of London, the Chancellor of the Exchequer was briefly imprisoned. It is important to note that the South Sea Company failed despite backing from the king and the government. The monarchy only put forward its interest before the people's interest. People invested in trusting the king, the government and the politicians and ended up ruining their lives. All this would have been avoided if people had avoided herd mentality and focused on the company's fundamentals. But greed always fogs the human brain, leading to catastrophe. Despite so many financial crashes, we continue to make similar mistakes forgetting past events. This is why it is important to revisit these historical events, reminding ourselves never to invest just because someone else is doing so and relying on research and strong fundamentals. Thank you for being with us so far. I hope you like our content. Please subscribe, like and share our content to motivate us to do such stories in the future.